Japanese yen plunged below the 160 level for the first time in 34 years, but in just 30 minutes during the midday session on Monday, April 29th, it surged nearly 400 points. This rapid move triggered speculation among market traders. Did the Bank of Japan intervene? Hi, I'm Jean, a researcher at Dxpert. Let's start with why the yen has been underperforming. I'm sure everyone is aware that Japan ended its years-long negative interest rate policy back in March. We have also talked about it in one of our videos. Yet the yen has still fallen 9% against the dollar since the beginning of the year. One major reason is the interest rate differential between the US and Japan. Additionally, hopes for an interest rate cut by the US Fed receded after data showed persistent inflation in the US. Nevertheless, the latest trigger for the yen's sharp decline was the Bank of Japan's announcement last Friday that it would not take further steps to normalize monetary policy, leading to a further drop in the yen. The yen weakened to around 160 per dollar on Monday, but bounced back to around 155 per dollar after Japanese authorities started buying yen and selling dollars, according to the People. Although the Japanese authorities did not comment on this, there were some other speculations. Shoki Omori, chief strategist at Nomura Securities, believes it may be due to thin market liquidity during public holidays, rather than intervention by the Japanese authorities, because low liquidity during holidays can easily exacerbate the decline of the dollar-yen pair. The fundamental reason for the depreciation of the yen and the appreciation of the dollar lies in the fact that compared to Japan, the US economy is experiencing high growth, high inflation, and high interest rates, making their differences in economic strength more apparent. The prolonged weakness of the currency primarily stems from the significant disparity between the US and Japanese benchmark bond yields, currently standing at 3.7 percentage points. Over the past 3 years, the yen has depreciated by over 40% against the US dollar. However, foreign exchange intervention cannot always reverse a substantial interest rate differential. We can see that since Japanese officials intervened in September 22, when the spread in benchmark yields was narrower at around 3 percentage points, the yen still depreciated by 8% against the dollar. Analysts at TD Securities also commented, intervention usually reverses the price action, buying officials some time, but it can't offset global macro forces. We need lower US rates or a hawkish Bank of Japan to meaningfully alter the yen's fate. As mentioned earlier, as long as the interest rate differential between the US and Japan persists, the yen is likely to continue to fall into a bottomless pit. Also, we cannot overlook the fact that the depreciation of the yen benefits exporters and stocks, as Japan Inc. derives 20% of its revenue from international sources. However, this decline also undermines domestic confidence in the future of the world's third largest economy and its capacity to manage its substantial debt. Therefore, this drag is likely to persist until there are clear signs that the US Fed will start a cycle of interest rate reductions. In our next video, we'll be talking about how the Japanese authorities can attempt to boost their economy rather than depending on global trends to prop up their currency. Don't forget to subscribe, like, and share this video if you liked it. See you in the next one.